So, should we buy or sell China? First off, read this disclaimer carefully. And do your good deed of the day by liking and subscribing. So, we have China in North Asia. So we are 23% here from the 52-week low. So we are frankly beating the S&P 500 by a lot. Minus 32-ish% away from the highs. So definitely still very much so in a bear market. So here you can see America, 1% from the 52-week low and minus 24-ish% from the highs. So let's just jump right into the charts. So this is, very big picture weekly data points. So the thing about, the China ETF is that, it has fallen down to a zone that is, interesting. So let me just draw it in with the right color, of course. So this, okay, wrong thing. It's like this. So this territory is a place where we often see, the bulls come in with bids. It is a low level, but we have been dabbling below some of these higher lows from the past. So we do have, some resistance. Given that we have seen a lot of sell-offs in all kinds of financial markets, it is especially interesting to look at territories where there is outperformance. And we do see that even though the S&P, as an example, let's go to the SPY, it's been going, down very significantly. China, it's been outperforming. That's interesting. Doesn't mean that the low is in, but it means that we are seeing low-ish behavior. When we look at some resistance levels that we need to be aware of, the purple 20-week moving average is obviously a very big deal. It is a pretty decent level for the bears to short. But what we do see is that previous week we did temporarily close above the 20-week moving average. And we also see that even though, yes, we did close below for this week, we do have a bit of a hammer candlestick here. So there's something potentially a bit dangerous here for the bears. This is not the type of thing you want to see as a short seller. When we look here at the daily data points, we see that the purple 20-day moving average here is a pretty clear support level, but the blue 100-day moving average is a relatively decent level for the bears. So we do have a bit of a battle now between the bulls and the bears. The clear sign, that the bulls are really, really back in the game would be to, get above the blue 100-day moving average and the purple 20-week moving average. Looking here at, these other indicators, it's we do see some constructive action here, some improvement in the RSI. We did get, a buy signal on the MACD here. When we go to the daily data points, accumulation distribution is still a bit weak. So that is the potentially a bit bearish thing I see here. You could argue, this was a sell signal on MACD. And RSI, it did face rejection from, a rather predictable level. It is a level that has spooked the bulls in the past. So what I write in the laboratory is 20 VMA and 100 daily moving average resistance. However, I will only give the bears a -2 here, and that is because we do see the bulls fighting a bit aggressively, and we do see that outperformance recently. So yes, the bears are still in control, but they are in a very precarious situation. When we look at seasonality, that is when it gets rather interesting. So to the left here, we see that in green over the last 5 years, from the 21st of June, which is the beginning of next week, all the way leading up into 22nd of July, the seasonality is very strong for China. In blue here, over the last 7 years, we do see some strengthening here leading into later June, but then we do tend to see some weakness. And in red, over the last 10 years, there is some strength into the late part of June. given that we still are, we are still in June, so that is good for June. Yes, going to the left here, we do see that over the last 5 years, June is one of the strongest months. The last 10 years, we do see that from June to July, seasonality improves significantly. Then over the last, okay, let's go 19 years here, like that. So June closes higher 67% of the time and is one of the strongest months for China. But then July, the next month, is the strongest month. That is good. So the seasonality score here is 6 bulls. This is pretty darn good. Now let's look at fundamentals. So we compare China with America. So let's just jump into the performance section. So year to date, China is down minus 13% versus minus 22% for S&P 500. So China is beating America. So if you bought China in the beginning of this year versus buying America, you are beating. Obviously, losing 13% is not good, but it is better than losing 23-ish%. Looking at beta, 0.64 versus 0.99, so significantly lower volatility. That is also something that the fundamental analysts want to see. Price earnings is 14.9. Okay, so let's get the numbers again, like that, 14.9. We plot it in here, and we do like this, and then we see that the price earnings for America is 53% above China. Looking at the dividend yield, 2% versus 1.22%, so better yield. Also, that this is the kind of stuff that the fundamental analysts want to see. 52 holdings versus 507. So definitely, less diversification in China. Sector breakdown, finance and tech is pretty big, but it's more evenly spread out here in, well, not really, because you do see that you have tech services is 17%, and then electronic technology, which also is tech, is at 15%, and then health tech is 11%. So if you add those three together, then all of a sudden the tech exposure through the S&P is pretty big. So interestingly, you could actually argue that the FXI is not really that, comparatively speaking, bad when it comes to diversification. So I will give 4 bulls here on the fundamentals. This looks decent. It means that the people who look at fundamentals are more likely to buy China than America. Now let's look at relative performance. So long term, there is a minus 10% correlation with between China and the S&P 500. There is an 8% positive with the WET, the total stock market ETF. 18% with the Europe ETF, VGK. Then 45% here with Japan, EWJ. Short term, 73% S&P 500, 82% total stock market, 87% with Europe, and 89% with Japan. So looking short and long term, the strongest correlation we do get is with Japan. So let's look at what is happening now with Japan. So we start long term, and we do see that there's definitively been a sell-off in Japan, pretty big. So we have fallen down to like an RSI level here, that if you look at it historically, so during like the C19 lockdown, yes, we did go even lower on RSI, but if you look at many other occurrences, looking at RSI and PPO, it looks very dangerous to short Japan at these levels. So even though, yes, the bears are still in control, looking at the history here, it only makes sense to short Japan if we have something similar to 2008 here, or the C19 lockdown. if we have any other kind of bear market, then this is dangerous if you are short, meaning it makes more sense to at least consider going long. Here are daily data points. We see something very similar. Yes, the bears are in control, but it's dangerous. Similar to how these upper overbought RSI levels are very dangerous for the bulls. Very low RSI and PPOs are very dangerous for the bears. So here I am comparing China with Japan. Yes, China has underperformed Japan ever since October 2007. So yeah, we have seen a very substantial downtrend. There's been a bit of a outperformance recently from China, and we looking at RSI, we haven't yet gotten into the territory that is like outright dangerous for the bulls. So there could be more left here. You see that definitively the upper end here of RSI is like the 70 region is where it's like, okay, now it's getting a bit too hot, but currently there could be more left. Looking at the daily data points here, you could definitively make the case that so let me get the right color. This looks like yeah, it's almost a breakout. My primary take on breakouts is that it's much better to get in early, before the breakout is official. Then again, given what we saw on the weekly RSI, there could be a bit more left here. So let's look at the seasonality. So in red, over the last 10 years, China usually substantially underperforms Japan. In blue, over the last 7 years, the same message, but here where it gets a bit more complicated. So over the last 5 years, there's been a bit of a shift in the seasonality. So China has a tendency to beat Japan, leading all the way up here into the 22nd of July. So that's interesting. So long term, no, you do not turn bullish on China, but looking shorter term, there's been a bit of a change here in the force. And now let's compare. We might as well actually compare China with the S&P 500. So yeah, so we have seen a very substantial downtrend. RSI has pushed us into a territory that is a bit dangerous for the bulls, but there could be more left. But the previous time we had this exact RSI level was back here, and that is when the outperformance peaked. So let's go here and look at the daily data points. Yeah, so we have this breakout set up here as well. Now looking at RSI, the problem is that the previous time we had this RSI level was here, and that is when China started to underperform America a bit. So on the daily data points here, RSI is sort of telling us that maybe there's going to be a bit of a rotation. So let's okay, so the seasonality over the last 10 years, blue in the last 7 years, definitively favors America versus China. Over the last 5 years in green, we then again here as well see that China has a tendency to outperform America. In this case, the relative performance score becomes a bit complicated because short term, it actually is rather favorable to China. Looking long term, especially the seasonality was problematic to say the least. I think I will give this very slightly to the bulls, but only a 1. So we end up with a score of 2.3. So the data is more favorable of bullish trades than bearish. The paradox is that we are still below some very important resistance levels. The purple 20 weekly moving average and the blue 100 daily moving average. They are solid resistance levels. The thing is that we have seen a very substantial sell-offs in the markets. If this is a traditional bear market or sell-off, then we do certainly expect some mean reversion to the upside at this point. The only caveat is, If this is similar to the global financial crisis or the C-19 lockdown, then we could go even lower. That is when you could have that final just panic flush down. So yeah, that's just the situation we are in. Whatever you do, of course, going forward, you definitively want to use some line in the sand and be market neutral. The reason why I'm such a fan of market neutral portfolios, that is because we do not really know what is going to happen in the future. So when you have an uptrend and you have bullish positions and bearish positions, then you are hedged if we do get some pullback. And also there's been many market conditions where both the long positions and the shorts are making money. Another thing is during a major bear market. Obviously, as it is happening, it seemingly makes most sense to be 100% short. However, we don't know exactly what is going to happen in the future. And during the C-19 lockdown and also the global financial crisis, when the ultimate low was formed early in 2009, many people were still massively short, and they continued to be massively short. As we got a bounce, they added to their short positions. The problem is, at the time, it sort of made sense, but in retrospect, we know that it really was a bad idea. And the only portfolio that really works in all market conditions, even though it is not perfect in any given market condition, that is to have a market neutral portfolio.